You guys seeing this bloodbath? The NASDAQ is down 2%, S&P is down 1.5%. But more importantly, the 10-year Treasury looks like it is Bitcoin at the moment. It is up 2.5% today, just completely shot up. We're going to get into why that is. Now, the reason that the market is down today, apart from the fact that we did draw this overall pattern months ago, really, if you've been watching this channel. But if you look at this overall pattern, this is just a confirmation of the head and shoulders. However, today was an especially brutal day because in my view, I think that there was a lot of fear injected into the treasury market, and it was done deliberately. I'm going to get into why I think that happened and where that fear is coming from. But as I said, the 10-year absolutely shot up today, looking like Bitcoin. Now, like I said, I expected this pattern to play out. As a matter of fact, if you've been watching my channel, if you saw my video yesterday, if you've been watching the videos for the previous weeks, I was saying that I think the 410, 415 level on the SPY is actually the level that we will likely drop to. Obviously, we could always go below that. But if you look at the volume profile, this is where most of the profile for the SPY rests ever since we hit all-time highs in 2021. And we've been heavily shorting the market. I even mentioned this in videos, how we're shorting the market. And we're currently up on this short about 40% on the SPY short. And today, as you can see here, I also shorted Google, and I also have a few runners open on Apple. So I have an active short on Apple, on Google, on the S&P 500 as well. Now, here's where the fear comes from. The fear comes from none other than CNBC's Rick Santelli. Now, I like Rick. I just think that this is a little bit hyperbolic and could represent the sentiment top for yields. I mean, he's just talking crazy here. Look what he says.
But there's your near 16%, SEP 81 for your anniversary date. And the whole point of this chart is that we have a lot of potential room to run to the upside. So if somebody asked me and held a gun to my head and said, listen, the worst case scenario, where Treasury rate's going to go 10-year, I'd say in the next 7 years, you should be able to see 13.5%, 14%. Yes.
So he's saying that the 10-year Treasury can get to 13%. And basically, he drew a line from 1981, which the 10-year was at 16%, and said that we can get there, right? I mean, we all know that's not really the way to do analysis, is just to draw a line at the all-time high in a very, very hyperbolic anomalous circumstance and say, oh, that's where we're targeting. Mind you that the federal funds rate in 1981 was above 20%. The federal funds rate right now, we are at 5.3%. So, you know, that completely is removed from his picture. He didn't mention the federal funds rate at all. Now, unless you think Jerome Powell is going to have a stroke and raise rates to 20%, there is no way in hell that the 10-year is going to 13%. Obviously, this scared a lot of people in the market, and we know that a lot of bond traders are also, represented by the older generation, right? And I think, in my view, they are a lot easier to sway. And you see the 10-year absolutely shooting up. Like, who's going to buy the 10-year Treasury after? And by the way, that video has millions of views all across social media. You're seeing that video spit out, all over social media. But another thing is that the Fed's balance sheet, if you look here, this is the lowest that it's been since June 2021. So we are still at the 8 billion mark, but I would suspect that by next month we will be below it. We'll be 8 billion. I wish it was 8 billion, 8 trillion mark. And by next month, I suspect we'll be just below that in the high 7 trillions. God, that is crazy that we're even talking about these numbers like they're even mentionable. But anyway, that's neither here nor there. The point is that there's so much supply because the Fed is rolling off assets off of the balance sheet, and nobody wants to buy treasuries right now, especially if the stock market is still providing good returns. But it's sort of this weird dichotomy, right? There's fear of buying treasuries. Treasuries are higher now than when inflation was at 9%. That makes no sense, right? That the yield that is being presented by treasuries is higher now than when inflation was even more of a threat. That makes no sense. You take a look at gold, and gold is supposed to be a bellwether investment during these times. Gold absolutely looks like a shit stock at the moment, right? Gold is trading, GLD is trading at 169. Sorry, let me move my head out of the way. Gold is trading at 169, which doesn't really make sense either. And then you have crude oil, which this obviously has to do with the cartel applying artificial shortage by not producing more oil. But I think oil is going back to the 90s and likely will be in the triple digits. I think this is just a temporary pullback for oil. So the market is looking a bit haywire right now, and really the big picture is not stocks. Like, to me, this right here was always expected for me. After forming this pattern, I do think that we were due for a correction, and hitting 4,100, 4,200 on the S&P 500 is not out of bounds for me. That's a typical correction. But this on the 10-year just looks absolutely insane. So this right here, obviously, a lot of what we have going on in the economy, whether it's mortgages, whether it's car loans, is based off of the 10-year rate. So as long as the 10-year continues to go up, that is going to put pressure on the economy. Now, it also puts pressure on stocks, which brings me to the reasoning that I think, I don't want to sit here and say that Rick Santelli is a bad guy, but we all know that CNBC and their suits, they know the platform that they have, and they are able to manipulate markets pretty easily. You've all seen that video of Jim Cramer talking about this openly, but I do think that they are trying to put pressure on stocks, and they are trying to cause fear in the market, and they are trying to get the best yields in treasuries, right? And I think that if you cannot influence the stock market to drop, right? I mean, you've all heard the tones that they've tried to use, that earnings compression is coming up, that earnings are going to be terrible. And nothing has, the stock market has been really, really resilient since last October. So now the stock market is being hit by rising yields, because I think they figured out that it's a lot easier to talk up yields than it is to try to artificially drop the stock market. Now, I do think something is going to happen here. Something big is going to happen here. In the white, you see the NASDAQ. In the red, you see the 10-year treasuries. Now, this is treasury prices. Remember that prices and yields move inverse. So the yields have been skyrocketing, which means treasury prices have absolutely tanked. This separation or this divergence is not really common, right? So I think that this at some point will resolve within the next year or so, and will probably resolve in the form of a recession, if you ask me, especially if yields continue to skyrocket. And I also posted this on Twitter. Be sure to follow me on Twitter and Instagram for free daily trading and finance content. But I posted this on Twitter as well. And I said this morning, I just thought of something. The last three major market crashes started in election years before the election. So 2020, 2008, and 2000, right? Now, obviously, some of you are going to be watching this saying, yeah, but in 2020, we had a pandemic. I'm not talking about the reason. Let's just talk about the facts on the ground, right? 2020, 2008, and 2000. Those were all election years. Next year is an election year as well. So I do think that the recession narrative fits with that election year crash too. Now, I do think that, as I said in my video from yesterday, I do think that stocks will bottom out in October to round the year off, and I think we will likely see a year-end rally. But by 2024, especially if rates remain high, and I think the Fed is going to do one more raise, I do think that in conjunction with an oversupply of treasuries and thereby skyrocketing yields, I do think the 10-year is going to 5%. I don't think it's going to 13, but still, I do think that if you keep that up and you keep that up for long, that divergence between the stock market and between treasuries is going to put pressure on the market, and we will eventually get a recession. Now, I'm just going to round off by saying it doesn't help that earlier this morning, we got the JOLTS job openings, and we saw an increase to 9.6 million openings. I think the estimated was 8.7 or 8 point something. Anyway, came in much, much hotter than expected. July was 8.8. And so 9.6 million job openings. This is definitely going to put more pressure on the Fed as well. And we will likely, like I said, get one more rate hike, whether it's November 1st or mid-December. I don't know, but I do think we are going to get one more rate hike. And I also just want to say that I heard your guys' feedback. So many of you put feedback in the last video saying bring back the top stocks video. So we will definitely be doing that. I will be telling you what stocks I'm looking at, and even if I'm not buying them myself, what I think would be good pickups, because it's not like I'm buying stocks every day. That's just unrealistic, right? Now, I am buying stocks when we hit major support levels, and oh, look at Google. How much is our Google position up right now? Damn, up 80% on this Google position. This is in real time. We took the short this morning. I better close it. The market closes in half an hour. But I am targeting a level down here, which was the open price. So if we can get to that level, we'll probably be up over 100% on this position. By the way, if you want access to all of my stocks that I'm buying, if you want access to my cash secure puts, you want access to my day trades, options, futures, etc., link is in the description below. If you see a promo code, make sure you take advantage of that. It'll cost you less than $4 per day. In my view, the best value you can buy if you are looking for a vibrant trading community that, in my view, is the most versatile and most profitable online. Just today, we had a long on futures, and then there was the short on Google, and then we had a short on futures to end the day. There are 3 analysts, including myself, and we are constantly sending out ideas, including futures, options, swings, spreads, cash secure puts, cover calls, etc. So you definitely want to be part of this group if you want to take your trading to the next level. And this is hilarious. Just while we're sitting here, another video just popped on my feed talking about treasuries not totally risk-free. Really. So the safest asset that is backed by the full faith and credit of the United States government is considered not totally risk-free right now. I mean, you can see this narrative playing in real time, right? And to be fair, I haven't watched the video, but I assume that they're going to say almost the same thing that Rick Santelli said yesterday, which was, if we're expecting rates to keep shooting up, then the value of your treasuries, because remember that yields and prices are inverse, that the value of your treasuries are going to tank. But that's not really the way to look at things. If you lock in, say, let's just say for simplicity's sake, if you lock in a 10-year treasury at 5% yield, that yield is locked in. It's not like they can now lower your yield. Yes, the treasury itself can then go to 6, 7, 8, 9%. But if 5% is good for you, then 5% is good for you, right? So the value of the treasury, if you were going to sell it before maturity, sure, is going to tank if yields keep going up. But the 5% that is attractive to you is still 5%. Now, in my view, there are better places to put your money. I personally like putting my money in some sort of mutual fund, like a Schwab mutual fund, and then being able to use that money. I'm earning 5% on it, and I'm able to use that money to sell cash secure puts, etc., or for different options plays. I did a whole video on this. Check that out here somewhere. And you could see I go through the step of how it is that I do this in TD Ameritrade, where I lock up my money in something that pays me 5%, but I could still use that money as collateral for cash secure puts and whatnot. Anyway, if you got anything out of this video, leave it a big fat thumbs up. I do think yields are going to continue to go up, not to 13%. I do think they will keep putting pressure on stocks, but I do think stocks will, barring some sort of credit event, will bottom out in October to round off the year, and then 2024 recession. That has been my pretty consistent view. If something changes, obviously you guys will know. I have no problem changing my mind if the data is actually sound, right? Leave it a big fat thumbs up. Leave it in the comment section below. Let me know what you think is going to happen to treasuries. Do you think Rick Santelli is off his meds? Or do you really think that 10 years is going to 13%? What do you think is going to happen in the stock market? Are you guys sitting in cash? Are you investing heavily? Would love to hear from you. Let me know in the comment section below. Again, join the trading group if you want access to all of our trades. If you see a coupon code or a promo code, consider yourself lucky. Make sure that you use it. Subscribe to the channel. Hit that notification bell. Stay safe out there, traders. Peace.